Morning everybody, and now I think hopefully everyone's joined, so very pleased this morning to welcome everybody to our webinar on EMI. I'm also very pleased to be presenting this with my partner David Pett. David's going to take us through the slides and most of the detail. Just a preliminary point is that if anybody has questions as we go along, we will be having the email addresses shown at the end of the webinar, so do please feel free to send emails either to David or myself. Without more ado, I'll hand over to David.
Thank you very much, Stephen. Good morning, everybody. EMI Share Options. A little bit of history. It was in 1999 when, for the first time, the government, acting through the Treasury and HMRC, invited a group of outsiders in to formulate policy in relation to tax legislation. A group of us were asked to go in and given a brief of coming up with a new form of share-based incentive for small, high-growth tech companies, which would afford tax relief in a manner which was acceptable to the Treasury and would be attractive to those companies who couldn't otherwise pay cash to attract senior executives from established companies. So what we came up with was the scheme of legislation that appeared in Schedule 14 of the Finance Act 2000. And I think, although I say it myself, we did a reasonably good job, because that legislation has remained relatively unchanged since then. It was reenacted as part of the wholesale reenactment of laws relating to employee share schemes in 2003. And it's been adapted from time to time to take account of the changes to CGT rules. But on the whole, it has remained in much the same fashion as was first intended. So what was the policy intent? Well, it was to allow small, high-growth companies to offer valuable incentives using shares rather than cash, assuming that they would not have sufficient cash flow to pay the levels of salaries needed to attract very senior individuals. Limits were set, but in such a way that companies such as Microsoft at the time, we're going back to 1999, would have qualified. I'm thinking here of the £30 million gross assets test. And of course, Microsoft at that time was a company that had relatively few gross assets, albeit that the value of its share capital was even then many hundreds of millions. The scheme was thought to be such a success that it was quickly emulated by other governments. The Singapore government sent a team into London for a week to interview those at the Treasury and the Revenue, and went back to Singapore, and within a few weeks enacted there a set of legislation that was based upon and very similar to the EMI legislation. At the same time, the Revenue liaised with their Shares Valuation Office in Nottingham to ensure that the Valuation Office was geared up to agree on a fast-track basis share valuations for the purposes of granting EMI share options. So, and experience has shown that the Revenue have been relatively very good in agreeing values in short order for these purposes. There are inevitably limits on the generosity of the Treasury in affording relief from taxation. There's an individual limit on the aggregate unrestricted market value of shares over which unexercised EMI options may be held by an individual, and that is now at £250,000. It started off at 100,000, then 150, and it's now £250,000. However, beware what's called the 3-year rule. In other words, if an individual has been granted EMI options up to the limit, then he or she cannot then be granted any fresh options above that limit within a 3-year period. So if, for example, the value of shares has fallen dramatically since the initial options were granted, and you might wish to cancel the original options and re-grant at the lower exercise price, if they've already had £250,000 worth, you cannot then do so within 3 years. But there's an easy way around that limitation, which is make sure that you only ever grant EMI share options up to just under the £250,000 limit, and then that restriction is sidestepped. There's also an overall limit on the aggregate UMV of shares over which all outstanding unexercised EMI options may be held at any time, and this limit is £3 million. So one always has to be careful to ensure that your generosity in granting EMI options doesn't tip you over this aggregate limit. Just as a side point, in applying these limits, they relate to the unrestricted market value of the shares, not the actual market value. And since most shares put under EMI options will count as restricted shares, it's very important when seeking agreement on valuation with the revenue to seek agreement as to both the AMV and the UMV. I've summarised on this slide the tax reliefs. The detail is reasonably complex, but the principle is simple, that any growth in the actual market value of the shares under option from the time of grant up until the time of exercise will normally qualify for exemption from the charge to income tax that would normally arise under the general charging rules in Chapter 5 of Part 7 of ITPA. That said, one of the beauties of the EMI is its flexibility, and it allows options to be granted with an exercise price set at a discount to the market value of the shares at the time of grant. Indeed, you could have a nil cost EMI share option. But in this event, the amount of the discount at grant falls to be charged to income tax at the time of exercise. I've sought to illustrate the tax treatment in these next four diagrams. So the first one is the straightforward situation where you have a market value EMI share option. The option is exercised. There has not at that time been any form of disqualifying event. In that event, the gain on exercise is exempt from income tax. In effect, when the shares are ultimately sold, the whole of the gain will be chargeable to capital gains tax, not income tax. The second one shows what happens if you have a discounted share option. In other words, the exercise price is set at a discount to market value at the time of grant. In that case, when the option is exercised, there is a chargeable gain equal to the amount of the discount at grant. But again, the growth in actual market value from grant to exercise will still be exempt. Moving on, I've referred to the occurrence of a disqualifying event, and we'll come back to see what a disqualifying event is. But at its simplest, if the employee leaves the employment of the company or the company ceases to be an independent company, those will be amongst the list of disqualifying events. There is a rule that provided the option is exercised within 90 days after the occurrence of a disqualifying event, then you don't lose the tax relief that I've already described. C illustrates what happens if the option is in fact exercised more than 90 days after the occurrence of a disqualifying event. And in that case, whilst there is still exemption from income tax for the growth in actual market value over the period from grant until the disqualifying event, any amount that accrues by way of gain following the disqualifying event falls to be charged to income tax under the general rules. And so D then looks at what happens in that situation where you've got a nil cost option, and you'll see there that the discount at grant falls to be charged to tax at exercise, as does any gain accruing from the time of the disqualifying event. So you'll see in those cases it's necessary to establish the market value of the shares not only at the time of grant but also at the time of exercise and additionally at the time of occurrence of the disqualifying event. And I've set out here just a simple illustration of the tax benefits of an EMI option as opposed to an unapproved option. And you'll see that on these figures, the saving both to the employee and to the employer, if the shares are readily convertible assets and would otherwise be chargeable to NICs, can be very substantial. I've set out here an example of an unusual situation that can arise, and it relates to the fact that EMI option shares are normally restricted securities for the purposes of Chapter 2 of Part 7 of ITPA. And therefore you would normally expect that at the time of their acquisition it would be necessary to enter, or appropriate to enter, into a Section 431 tax election. The legislation provides that if it is a market value share option, then there is deemed to be a Section 431 election made. One of the consequences of that is that by using the grant and exercise of an EMI option to acquire restricted shares, the difference between AMV and UMV will fall out of account. If it is not a market value option, then one has to consider whether it is appropriate to make a Section 431 election in a positive manner. However, if you start off with a discounted share option and the value falls, making a Section 431 election can result in an additional amount of tax or greater amount of gain falling to be charged to tax than would otherwise be the case. So this is a potential pitfall, and one has to be very careful. You'll see that on this example that I've posted up, although it's a discounted option, the share price has fallen over the period, but it's still worth exercising because there is a gain. But if a 431 election were to be made in these circumstances, it would curiously increase the amount on which income tax is payable on exercise from £6 to £8. Remember that, like many other employee share options, provided conditions in the Corporation Tax Act 2009 are satisfied, the employer company will normally be entitled to relief from corporation tax for an amount equal to the gain realised on exercise of the share option. That remains good for EMI share options, even though the employee is exempt from tax on the gain in actual market value. However, there is a trap here, because if at the time of exercise the company has been the subject of a takeover or has lost its independence, then you will find that that relief from corporation tax may be lost. And so if the options are to be exercised upon a corporate event such as a takeover, care must be taken to ensure that the timing of the EMI options is such as will ensure that that potentially very valuable relief from corporation tax is preserved. That's a pitfall that's easily fallen into. So going back to the requirements for EMI options. First of all, the company whose shares are put under option must be a qualifying company. It must have not more than 249 full-time equivalent employees and directors. For these purposes, you can exclude those on maternity or paternity leave, etc., and any students engaged on vocational training. Note that although the legislation refers to a limit of 250 employees, it must not be more than 249 full-time employees. So if you've got 250, you're counted out. Secondly, the company, or if it's the parent company of a group of companies, the group must have gross assets of less than £30 million. You remember I referred earlier to the fact that Microsoft would have qualified way back in 1999. For these purposes, we're looking not at gross assets as shown on the consolidated balance sheet, but rather the sum of the gross assets of each company within the group. And for these purposes, one leaves out of account the value shown in the accounts of each company of any shares or investment in securities in a subsidiary. Now, it may well be that on the face of it, you have a situation where a group of companies has assets of more than 30 million, but were it to pay off some bank debt, for example, it could bring itself down below that limit in order to qualify to grant the EMI share options. And we've come across one or two cases where that's been very effective to reduce the gross assets temporarily to enable options to be granted. The company must be independent. It must not be under the control of another body corporate. And also there must be no arrangements for the potential loss of independence of the company. So, for example, be careful about loan security documentation, which includes provisions for the bank or the investor to acquire control in an event of default. In practice, the Revenue have confirmed that provided that is part of the normal security documentation of a bank or third-party lender, and it is sufficiently remote, then they will accept that that of itself is not an arrangement for the loss of independence. But it is rather grey area, and again, care must be taken to check that there are no such arrangements in existence. The company itself, or if it's a parent company of a group, no member of that group must carry on a disqualifying activity, and at least one company within the group must have a permanent establishment in the UK. It doesn't matter, therefore, if all your sales are overseas or your manufacturing is overseas, provided that within the group one company has a permanent establishment in the UK. If the company is a parent company, then all subsidiaries must be under its control. The EMI company must own 51% of any subsidiary, and no other person must have control of any subsidiary. That said, you can have non-controlled subsidiaries, i.e. the EMI company can have minority holdings by way of investment in other companies, but any subsidiary of which it has control must be a 51% subsidiary. There's an exception in relation to property companies. Any property managing subsidiary, as defined in Schedule 5, must be at least 90% owned. And again, there must be no arrangements existing which would cause the independence or the subsidiaries tests to be failed. Beware the existence of joint ventures, and here I'm referring to pure 50-50 joint ventures of which neither joint venture partner has control as per the test in section 995 CTA 2010. The Revenue have in the past asserted that this disqualifies the JV partner from qualifying to grant EMI options. In my opinion, that is not correct, and there is case law authority which is against them, and I'm referring to passages in the UBS Deutsche Bank decision of the Court of Appeal. I said that there must not be disqualifying activities, and the activities of the company or of any member of the group must not consist as to a substantial part, and here that means 20%, of excluded activities. And these are what are perceived as low-risk activities, and the list is what you might expect: dealings in land, commodities, securities, dealings in goods, otherwise as wholesaler, retailer, and so on down the list here. Note the more recent exclusion of shipbuilding, coal and steel producing companies. That's all concerned with the EU rules on state aid. Operating hotels, managing nursing homes, etc. Insurance. I would point out that there is a difference between being an insurer and being an insurance broker. And in our experience, the Revenue accept that a pure brokerage operation will qualify, whereas, for example, an insurer, which also carries on brokerage activities, would not qualify. Turning then to the employee to whom the option is offered or granted, he or she must be an employee of the EMI company or a qualifying subsidiary, and must be committed to at least 25 hours per week, or if less, 75% of his or her working time. And committed time includes sick leave, maternity leave, reasonable holidays, and even garden leave in the case of someone who's been put on notice of termination. Working time here means time spent on remunerative work, in other words, earnings or profits which are taxable in the UK, either as an employee or as a self-employed. So supposing you have an individual who only works 20 hours a week, they can still qualify if that is at least 75% of the time they commit to any form of profitable activity as an employee or self-employed person. We were once asked whether time spent sitting in the benches of the House of Lords constituted working time. Apparently it does so. There is a material interest test. The employee must not have or be deemed to have a material interest in the EMI company, or if it is a close company, the assets of that close company. And here we're talking about an interest of 30%. The test is applied at the time the option is granted, not at the time of exercise. So that's different from the way it's applied in relation to CSOP share options. Likewise, there's no look back of 12 months. The test is applied at the time of grant. It doesn't matter that the individual might have had a material interest at an earlier point in time. Interests of his or her associates count, but curiously, a sibling is not treated as an associate for these purposes. So if you've got children working in a family company, the consequence of that may be that they do qualify, although of course the sibling will be associated with the parent and so may fail on that basis. The shares over which the EMI option itself is granted are to be left out of account for these purposes, but shares under other forms of share option count. If they're subscription options, then the ordinary share capital is to be grossed up for the purposes of determining if the employee has a material interest. And do beware the existence of employee benefit trust. There are very complex rules in Chapter 10 of Part 7 ITPA defining an employee benefit trust and setting out rules for determining whether shares held in that trust must be counted as part of the holding of an individual for the purposes of the material interest test. Turning then to the actual shares to be put under an EMI option, they must form part of the ordinary share capital. In other words, they must be entitle the holder to participate in more than just a fixed return on the capital paid up. They must be fully paid up. In other words, they must be issued and transferred for an immediate cash payment. This goes beyond what people might normally understand by fully paid shares. It's not just that they must be fully paid as to their nominal or par value, but that they must be, when first acquired, the amount paid for them must be paid up in full. And this does mean that certain cashless exercise procedures simply wouldn't work and would put at risk the qualifying status of the option. Deferred payment for the issue of the shares being one example. The shares must not be redeemable. However, an obligation, either in the Articles of Association or a shareholders' agreement, to offer the shares back for sale to the company does not of itself make them redeemable for these purposes. You may use a separate class of restricted shares for these purposes. The shares do not have to be of a single class of ordinary shares, and one may go further and have shares with rights which are drafted such as to ensure that the value of the shares reflects not the value of the company as a whole, but rather the value of a particular underlying subsidiary or business. So in other words, there's an effective look-through. And the received view is that that does not offend the purpose test for EMI share options. However, do make sure that the shares are not convertible. Because of the way the tax rules apply to convertible securities, you can effectively lose all of the benefits of an EMI share option because the gain on conversion would nevertheless fall to be charged to income tax. Process and procedure. Well, first of all, the option must be granted pursuant to a written option contract. You can typically have either a long form rules and a short form option certificate, or a long form option bilateral contract executed by both the individual and the company. I think our preferred route is to have a long form set of rules, a short form certificate, or have a unilateral grant by the company on terms of long form rules, but then have the individual execute a form of acceptance. One's got to be a little bit careful here, because you have to ensure that the obligation to execute and return a form of acceptance, agreeing to accept and be bound by the rules of the plan, is a condition of exercise, not a condition of grant. Because if it's a condition of grant, the revenue will say, well, the option hasn't been granted until the form of acceptance has been executed and returned to the company. And if there's been a shift in share value over that period, you could find that the option is granted at a discount to market value if that was what you did not intend. The written contract, whatever its form, must state that the option is granted as an EMI share option. It must state the number or maximum number of option shares, the exercise price, when and how it can be exercised, and any conditions of exercise. And further, if, as will normally be the case, the shares are restricted securities, then it must include details of the restrictions. And for these purposes, cross-referencing to the articles is not good enough. There needs to be some specific reference to the restrictions. It may well be easiest to include an appendix which summarises the restrictions attaching to the shares. The option must be exercisable within 10 years of being granted. If it's capable of being exercised more than 10 years and is in fact exercised after the 10-year anniversary, then it will not qualify for the favourable tax conditions. And we've now had examples of situations where, for example, an option's been intended to be exercised upon a sale of the company, but that has not happened within 10 years. The revenue will not allow you then to go back and extend the period of exercise to allow for it to be exercised more than 10 years or after the long stop date that's already in the share option contract. The option contract must also make clear that the option is non-transferable. The only circumstances in which it can be exercised by someone other than the person to whom it is granted is upon the death of the option holder. And in that event, it must be exercisable, if at all, only within 12 months after the death of the individual. One of the other requirements is that the grant of the option must be notified to the revenue. It used to be the case that there was a form of notification which had to be signed by the employee, and in signing it he was agreeing to or declaring that he satisfied the working time requirement. Because the notification is now made unilaterally online by the employer company, that declaration that the individual satisfies the working time requirement should now be incorporated in the option contract or the share option documentation. Before granting an option, always seek prior agreement from HMRC Shares Valuation as to the AMV and the UMV of the shares at grant. This is not only to ensure that the statutory limits are not exceeded, but also to ensure that the exercise price is either not at a discount to market value, or if it is, to establish from the outset what is the amount of that discount, so that the employee has certainty of knowing the amount on which tax is to be charged at the time of exercise. The grant must be notified to HMRC online within 92 days after it is formally granted. That is to say, the option agreement is executed by all parties, or if it's a unilateral grant by the company, the date of unilateral grant. And furthermore, the option or the scheme, the plan, must be registered with HMRC online before 6th July in the next tax year. If you don't register the plan online, then you can't make your annual year-end return, which has to be made before 6th July after the end of each tax year, until there is a complete tax year in which there is no outstanding unexercised EMI option. So even if there's been no activity over the year and you give a nil return, you are still required to make an annual return. I referred earlier to disqualifying events. These are events which, unless the option is exercised within 90 days thereafter, would at least curtail the entitlement to exemption from income tax on the growth in actual market value. And I've put down here on this slide a list of what those disqualifying events are. The principal ones are the company losing its independence because there is a takeover, for example, or a sale of the company. There is provision in the legislation for options in that instance to be exchanged for corresponding rights to acquire shares in the new holding company, and provided detailed requirements are met, those replacement options will stand in the shoes of the old ones and still qualify for the release from income tax. Another disqualifying event is if the company or any member of the group ceases to meet the trading activities requirement, possibly because the business is sold, for example. A company qualifies if it's preparing to carry on a trade, but if it does not in fact ever carry on that trade within 2 years, then that is itself a disqualifying event. If the option holder leaves or ceases to be an eligible employee, then that is a disqualifying event. Note that there is a second test, which is that at the end of each tax year you have to look back and see whether in that tax year the employee has satisfied the commitment test, the commitment to 25 hours a week or 75% of working time. If that is not the case over that tax year, then there is a disqualifying event at the end of that tax year. Certain variations of the option terms, if it increases the market value of the option shares or any of the statutory requirements are no longer met, that will be a disqualifying event. Also beware alterations of the share capital, because if the consequence is to vary a restriction and that affects the value of the shares under option, that will be a disqualifying event. Likewise, if it results in the requirements of the legislation no longer being met, or it affects the value of the shares for something other than a commercial reason. A conversion of the option shares, unless certain conditions are met, is also a disqualifying event. So beware capital reorganisations where you may end up with shares with different rights. Technically, that may amount to a conversion of the option shares, and in that event you have to look carefully at the conditions in section 538. For the purposes of the £250,000 individual limit, options granted as CSOP options count. So insofar as one might have £30,000 worth of CSOP options, the employee could then only have £220,000 of EMI options on top. A disqualifying event occurs if any further CSOP options are granted so as to take the individual over the 250,000 limit. I mentioned the circumstances in which there could be a qualifying exchange of EMI options. This is if control of the company passes in consequences of a general offer or a court-sanctioned scheme of arrangement, or there's a compulsory acquisition in accordance with the provisions of the Companies Act, or if there's what's called a qualifying exchange of shares. In effect, this means where there is an interposition of a new holding company such that the shareholdings before and after are identical. Then in any of these circumstances, within time limits, EMI options may be exchanged for the grant of replacement options over shares in the new holding company. The new co must meet the independence and the trading activities requirement. Provided all the conditions are met, the replacement option is treated as granted when the original option was granted and in effect stands in the shoes of the original option. If you read the legislation, it says that the £3 million overall limit must be applied at the time of the exchange. In practice, my understanding is that the revenue accept that is not how it works. They will accept that provided the £3 million overall limit was met at the time of grant of the original options, then it doesn't matter that the aggregate value of shares under the replacement options then exceeds the £3 million overall limit. And that was to rectify a mistake in the original drafting of the legislation. Now, of course, entrepreneurs' relief is available in respect of EMI option shares, notwithstanding that the option holder may acquire a holding of less than 5%. However, to qualify, there are certain conditions that must be met. The disposal of the shares must be at least 1 year after the grant of the EMI share option. Note it's the grant, not the exercise, as some people have suggested. The shares must have been acquired pursuant to the exercise of an EMI option within 10 years of grant and within 90 days of a disqualifying event. And furthermore, throughout that last year prior to the sale, the company must have been a trading company or holding company of a trading group, and the shareholder must have been an employee or director of a member of the group. So note that you've got to remain an employee or a director throughout that period. And it may well be that there are circumstances in which an employee is required to sell shares or required to step down as an employee or director before the shares are sold, in which case the availability of that entrepreneur's relief is going to be at risk. So just some pitfalls. Note that non-executive directors are not eligible even if they work for more than 25 hours a week or more than 75% of their working time. You've got to be an employee. If the option is exercised more than 90 days after a disqualifying event, that will curtail the relief from income tax. It will, however, lose the benefit of the entrepreneur's 10% rate of CGT on sale. By contrast, if you have an exchange of options after a disqualifying event, that curiously voids the income tax relief from the outset. As I said before, avoid the use of convertible shares, avoid or check to ensure that no member of the group carries on an excluded activity. I should mention that there is also a subtly different requirement that the company or any group company must not hold significant, 20%, non-trading assets. And we have come across situations where, for example, a company holds quite a large amount of cash or investments in non-trading assets, and that then counts it out as qualifying. So, for example, we had a quarrying company which kept a fund which it was amassing for the purpose of landscaping the spent quarry after some years. It was held that did not qualify because the cash, albeit that it was kept for good commercial trading purposes, was a significant non-trading asset. I've mentioned the difference between brokerage and trading as a principal. Beware also royalties or license fees. There is a special rule which says that you're counted out if a substantial part of your income is in the form of royalties or license fees, but not if it's in relation to software or a process that has been developed by the company itself. What this test is looking at is excluding those companies that buy in assets or software and then license it out on a basis where there's perceived to be very little risk. I've mentioned the use of restricted shares and of shares the value of which reflects that of an underlying subsidiary or underlying business. Disguised remuneration rules. There are special provisions in Section 554E of ITPA, which generally protect against disguised remuneration charges in relation to the use of EMI options, even if the option is granted by a relevant third person, such as, for example, an existing shareholder, as opposed to the company itself. But it's always worth checking against those provisions to ensure that a transfer of existing shares from an existing shareholder in satisfaction of an EMI option will not fall foul of the disguised remuneration rules. So what are the different types of EMI option that people use? It's very common to see exit-only options. In other words, the option is normally exercisable only upon a sale of the company or a change of control or flotation of the company. In those cases, if the employee leaves for any reason before the occurrence of that event, the option would typically lapse, or if he's a good leaver, he might be able to retain the option in whole or in part, but again, exercise it only if the exit occurs within a defined period. Alternatively, you might structure the EMI option with a vesting schedule. In other words, the right to immediately exercise the option accrues over time. I've seen one recently where 6.25% of the shares under option become immediately exercisable at the end of every calendar month over the next 3 years. Likewise, you might grant on the basis of performance linking. So provided the performance conditions are objective, then there is no reason why it cannot be drafted so that the option is only exercisable upon the attainment of those conditions. The conditions need to be objective, because if they are not and are at the discretion of any individual, then it's arguable that the option is not a right to acquire shares, and therefore doesn't satisfy the basic requirements of an EMI share option. Always check the Articles of Association of the company. In particular, if the option is capable of being exercised before an exit event, then it's normally necessary to ensure that proper provision is made in the articles for protecting against the shareholder or option holder come shareholder disposing to a third party, or if there's a compulsory offer for sale back for value if they're a good leaver, or nominal value if they're a bad leaver, for example, and to ensure that there are permitted transfers to or from an employee's trust, just to allow the flexibility for the operation of employee share schemes, and to ensure that you include tag-along rights. Generally speaking, all those provisions ought to be in the articles before the option is granted. There is some case law from New Zealand which supports the idea that the changes to the articles after the grant of rights to subscribe for shares may not necessarily be enforceable, or if they adversely affect the individual may give rise to a claim for damages against the company. And what if for any reason your client company does not qualify for EMI share option, or wishes to grant options in excess of the statutory individual and overall limits? Well, there's CSOP options, but remember that CSOP options count towards the £250,000 EMI limit. Generally speaking, though, a company which qualifies to grant EMI options will also qualify to grant CSOP options. It won't necessarily qualify to grant SAYE share options, but those of course are for all employees, whereas EMI options may be granted on a discretionary basis to employees who are key to the business. So an alternative might be the creation of growth shares, or the award of joint share ownership, or the use of the new style employee shareholder status, or shares for rights, which of course does offer a more generous tax treatment on the disposal of the shares, although the acquisition of the shares will attract charges to income tax insofar as the value is greater than £2,000. It occurs to us that it would be so simple if only a company could typically, if it qualifies to do so, grant EMI options to subscribe for a class of employee shares, which may be restricted. They're granted with an exercise price set at market value, When they are exercised, the employee may then sell back those option shares to the company itself. The company would get corporation tax relief for the share option gain, and the employee would qualify for relief from income tax on the growth in value. If the employee chose to hang on to the shares, then with the new rules on dividends coming in next year, the company could pay dividends of up to £5,000 per employee on his holding of shares, and those dividends would be tax-free under the proposed new relief. That type of arrangement would allow the company to ring-fence a percentage of capital in the form of shares earmarked for employees. It would avoid disguised remuneration pitfalls. It would avoid the need for an offshore employees trust to buy back shares. The shares could be bought back out of distributable reserves into Treasury and then used to satisfy the grant of fresh EMI options going forward. It would allow the participating employees to benefit from the tax relief, both from income tax on exercise and the entrepreneur's relief rate of capital gains tax on sale back. However, as things stand, this recycling structure doesn't work unless either the shares have been held for at least 5 years from exercise of the option, or they are first acquired as employee shareholder shares and the employee has left. Why not? Because of this rule that where shares are sold back to the issuing company and they have not been held for at least 5 years, then any amount received as consideration in excess of nominal value plus premium on issue is treated as a dividend for tax purposes. And this can result in some circumstances in a form of double taxation, although if you're using EMI options, it's only a single taxation, but it's still a dividend tax charge that for higher rate payers can be penal. So what we really need is for the government to change the rules to allow any employee shares to be repurchased by the issuing company with no dividend tax penalty, even if they're bought back within 5 years. Without that, companies in effect have to set up an employees trust. Employees who sell their shares to the trust would then be treated generally as selling by way of realising a capital gain rather than receiving dividend income. Offshore, because that avoids the prospect of the pitfall of double taxation, the government has not thus far gone so far as to put beyond all doubt that there will be no double taxation if a UK resident trust is used, hence the popularity of offshore employee trusts. I mentioned the need to seek agreement as to share valuation in advance. When seeking agreement, always ask for agreement as to both unrestricted and actual market values. The latter because it's the growth in AMV that qualifies for the exemption from income tax, but the limits of course apply to the unrestricted market value. Typically for small holdings under EMI options, quite generous discounts have been agreed by the inland revenue. So to finish with just a few planning ideas, if an employee is to acquire a small holding which wouldn't otherwise qualify for entrepreneurs relief, then by granting and allowing him to exercise EMI options, even if that is within a relatively short space of time, would allow him to access the more favourable 10% rate of entrepreneurs relief. And remember the value of the corporation tax relief on the increase in value over the option period. If there is to be a sale of the company, but we're not yet at a point in time where arrangements are in existence for a loss of independence, then it may well be appropriate to grant EMI options as exit-only options, even at a relatively late stage. And always consider granting EMI options instead of a pay rise. After all, that is what the original policy was intended to allow. Just to end up, how can Pett Franklin assist you in relation to EMI options? Well, we're always happy to have an initial discussion to see where they fit in with your commercial planning, to help identify if the company qualifies. If there's any doubt in that, there is a clearance procedure with the Small Companies Enterprise Centre of the Revenue in Nottingham, and they're very good at coming back in short order to agree or not, as the case may be, as to whether a company qualifies. We can assist with any amendments needed to articles or shareholders' agreements, and of course in drafting EMI share option documentation and the necessary resolutions of the shareholders or the board to grant, and in seeking share valuation agreements. So I'm going to finish there, and in the words of a comedian that some of the older ones amongst you might recall, I'm going to sign off by saying, if you have been, thanks very much for listening.
Okay, well, thank you very much, David. Hopefully everybody found that helpful and illuminating. I think that's our last webinar before Christmas, so I will wish everybody good season's greetings, and hopefully we'll be returning in the new year to listen to our further webinars. As I said at the beginning, if you have any questions, do please feel free to email those into us, and we'll be happy to look. So thank you very much. Goodbye.